Welcome back. We continue with our earnings focus. This time it's IndusInd Bank. The first quarter FY25 was a bit below street estimates. Net interest margin came in at a 7-quarter low, just marginally lower than previous quarter. Asset quality also saw some trouble, but the business momentum was healthy, 15% growth in deposits and almost that much in advances. Sumant Kathpalia, Managing Director and CEO of IndusInd Bank, is with us. Sumant, good morning and thank you very much for joining us. Actually, the banking sector itself has been under a bit of pressure, but I'm looking at the analyst reports written about you. ROE, RoA are both lower than the previous quarter, as was the net interest margin. According to you, what was the problem?
So, good morning and thank you for inviting me. I think it was a very stable quarter. And yeah, of course, the quarter one is generally a weaker quarter and it got also impacted by some external factors. But I continue to believe if you look at, our two domains, which is microfinance as well as vehicle finance, and specifically in the rural belt, we did have a slowdown to large extent, and they are high-yielding portfolios of ours. And we did not want to push it at this point of time also. So I think if you look at the revenue growth was a tad lower, but I think our NIMs were maintained. Our fee, because of the processing fee going down, I think it got impacted. And if you look at our expense, actually for the first time our expenses have come under control in the last 4 quarters, and we were 2% quarter-on-quarter growth. So I continue to believe once our acquisition ramps up, I think, and which is already happening, I think you will start seeing us getting back into the RoA margins which we've set to ourselves, which is 1.8 to 2.2%.
Okay. By when do you think you can get over there? I mean, you're not a big distance from there, but when do you see 1.8? When do you see 2%?
So I think quarter 3 onwards, you start seeing 1.8 coming back. And I think by quarter 4, we should be between 1.9 and 2.
Okay. To some extent, God is against the banks. And by God, I mean RBI. The LCR rules are clearly going to mean that you have to put aside a little more money into government bonds, which obviously are not going to fetch you more than 6-7%. So how much do you think your costs may go up? What is your LDR now anyway?
122%. LDR is about 88%, 87.5.
87.
And,
okay, sorry. LDR is 87.
LCR is about 122.
Okay, so will you want to bring it to? Will you want to keep it at 122, or will you now be okay with 110?
So our board is, we've got an internal guideline that we should be 110% and above, but we've always kept it at 115% and above for ourselves. So I think while the LCR guidelines are being finalized, I think there is a single-digit impact to us which we've calculated, and we should be able to fine-tune our liability strategy to take care of that.
Okay. Regardless, there will be a war for term deposits because, there is an obvious attraction there, and deposits have been growing far slower than advances. So, therefore, how will NIMs pan out in the current and next quarter? When do you see it perhaps inching up?
So we've always said that our NIMs are range-bound between 4.2 and 4.3. You should have seen it in the last 8 quarters. We are very range-bound between 4.2 and 4.3. And I think in higher interest rates, we will be at 4.2, 4.3. In lower interest rates, even with the LCR, we should be at 4.2 to 4.3.
Yeah, of course, you're a distance from 4.2 anyway. And as you point out, you have an LCR buffer. The slippages bit now, you speak about, you said that MFI and some rural pockets did see stress. Is this likely to abate? Because, I mean, while I agree with you that agri loans are always a first quarter thingy, MFI has been a matter of concern for the last 6 months, even with NBFCs. So how do you see the overall stress panning out?
So I think, Latha, what is more important in an MFI business is the approach which you take towards credit. Growth is not the only criteria you should be looking at. You should be able to identify districts and states where you think over leveraging or some external pressures are building up. So for example, there were states like Odisha or Punjab, for example, I'm saying it. We actually started slowing down our businesses 6 months before that. So if you look at, we've always said our MFI portfolio will have a gross NP of 3.5% and 2.5% credit cost. We've been range bound in that range. So even if you see this quarter flow, it's 330 crores flow. So it's not that we've increased our flow dramatically on MFI, contrary to what the market is saying. So we are range bound between 330 to 350 crores, which is about 3.5%, and our credit cost is between 2.5% to 3%, and we've been range bound in that.
No, fair point. I mean, all businesses, all banks have some high risk, high return businesses and low risk, low return businesses. I take your point on that. I think the market's getting disconcerted because slippages did go up. The slippage ratio has gone up. So, I mean, what is the guidance on that, therefore?
So, we don't give guidance on slippages because we have some cyclical portfolios. For example, first quarter is a very weak quarter on the vehicle finance business. We had 680 crores of flow against the 475 crores of flow. So if you look at our flow, the 10% increase, 90% of that has happened in the vehicle finance business.
Okay.
And I think we don't give guidance, but we've given guidance on the credit cost, which is 110 to 130. And if you see us, we've never busted 110 to 130 basis points of credit cost.
What is your cost of funds, Sumant, and how much might it inch up in this phase of war for deposits?
So I think from last quarter to this quarter, we had a 5 basis point increase in cost of deposits and 3 basis points increase in cost of funds. Overall, our cost of deposits over the last 7 quarters has inched up by about 130 basis points.
Do you think banks in general
because
are
more and more is moving to term deposits?
Okay. Yeah, absolutely. Do you think banks will rely more on
to term deposits?
I'm sorry, there is a voice lag. Do you see banks like yourselves going more into CDs now because the bond market rates are dipping for other reasons, bond index, LCR demand, etc.?
I think I've said that our dependency on the CD market should not be more than 3 to 5%. We've always kept that. If you look at today also, we are at 2.8%. I continuously feel that you should not take shortcuts in this. We are low on retail. I think we have to granularize the portfolio. Our dependency on borrowings as well as CD markets will be low. But in the deposits, we may play for some time the bulk deposit game.
Sumant, what is the likely impact of the project finance provisioning that is going to come in sooner or later?
So, Latha, we've looked at our portfolio, and if you look at the composition of our portfolio, the impact will come more in the real estate side for us. I think it's a couple of hundreds of crores over a period of time. So I think, and we will do some pricing adjustments once the regulations are clear. So it's not such a big impact because we've not focused on project finance so much. We have some real estate portfolio, 5% of our book is in real estate. So that's the only impact.
Okay. Now to come to capital raising, markets in a kind zone, Nifty nudging 25,000. Will you all want to use the opportunity to raise money?
We've just assessed our capital needs. You've seen the results. It's 16.15 CET1 and overall capital adequacy ratio of 17.5. I really don't think there is a need for us to raise capital. If we are growing at 18 to 22%, our internal accrual should be sufficient to take care of that as long as we are managing our risk-weight assets. We will assess it in another 6 months now, and we will see whether we want to raise capital. As of now, we don't have a need to raise capital.
No, there's this strange thing about capital, isn't it? When you don't want it, the market is very kind. But sometimes when the market is unkind, you need the money, and that's why people normally pick it up when it's available. Anyway, we will know in 6 months. Just a final question. There is this constant chatter in the media about Reserve Bank giving permission to the Hinduja group to raise its stake to 26. Anything you can, clarify for us with certainty?
So I can't talk about the promoter entity, but I can only say they've asked us for the fit and proper, and that's where we've given our submission, whatever the Reserve Bank asked us. And I think it's between the promoter and the regulator. We've not heard anything from the regulator.
Okay, that's most useful. Thank you very much. Clarifies a lot of doubts. Sumant Kathpalia, always a pleasure speaking with you. Thank you very much, and hope you have an eminently successful FY25 too. Okay, so that's the word. That's the word coming in from IndusInd. They are staying in a range, whether it is RoA or whether it is margins within that 4.2, 4.3% band as far as margins are concerned, and credit costs under control, as they say. Guidance is 110 basis points. Well, markets still in absolutely flat terrain except for the mid caps. But on that green note, we wrap up on Bazaar. Chart busters coming up.